Before I review the functionality of the webinar, I would like to bring to light that Aptus Value Housing Finance is an entirely retail-focused housing finance company, primarily serving low and middle-income self-employed customers in the rural and semi-urban markets of India. They are one of the largest housing finance companies in South India in terms of AUM as of March 31st, 2021. The company offers customers home loans for the purchase and self-construction of residential property, home improvement and extension loans, loan against property and business loans. Moving ahead, you'll be kept on mute throughout the event and all questions will be answered by the Q&A chat box only, where you can type your question in session or at the end of the webinar. Would request all participants to please limit yourself to 3 questions if possible and use a lowercase font while typing the question. If we miss answering any of your questions, don't worry. You can email us at ipoteam@conceptpr.com and we will try to be swift in responding back to you. Going forward, it is our great pleasure to introduce our speakers today. From the company, we have Mr. Munuswamy Anandan, Chairman and Managing Director, Mr. Balaji P, Chief Financial Officer, Mr. Subramaniam G, Chief of Business and Risk. The representation from the book running lead managers are Mr. Amrut Kalantri, Vice President, ICICI Securities Limited, Mr. Arvind Vashisht, MD, Head ECM India, Citigroup Global Markets India Private Limited, Mr. G.B. Jacob, Managing Director and Head Capital Markets, Edelweiss Financial Services Limited, and Mr. Viren Jairat, Director ECM Kotak Mahindra Capital Company Limited. On behalf of the company and the lead managers to the issue, let me thank all participants for being a part of this session and now invite Mr. G.B. Jacob from Edelweiss Financial Services to deliver the opening remark and commence this brokers and analysts meet. Over to you, G.B.
Thank you, Lalit. Good afternoon, ladies and gentlemen, and a very warm welcome to the broker and the analyst meet for the IPO of Aptus Value Housing Finance, an industry leader in affordable housing finance sector in southern India. I would like to thank all of you on behalf of Aptus and the lead managers to the issue for taking out your precious time to attend this meet. Aptus is a brainchild of Mr. Anandan, a financial services industry veteran with over 4 decades of experience. It's the story of a very successful professional turning into a very successful entrepreneur. With early backing from Westbridge, one of the leading private equity firms of India, Aptus grew to what it is today. From a very humble beginning in 2010, Aptus has now come a very long way to become one of the largest affordable housing finance company based out of southern India, with an AUM of around 4,068 crores as of March 2021. Aptus has seen its AUM grow at a staggering 48% CAGR between fiscal 2017 to fiscal 2021. And this growth has come with consistently maintaining industry-leading asset quality, NIMs, yields, and a best-in-class return on assets. The company has demonstrated the highest standards of corporate governance since inception. As Lalit mentioned, company is an entirely retail-focused housing finance company, primarily serving low and mid-income self-employed customers in rural and semi-urban areas of India, with a sweet spot of around 8 to 10 lakhs per loan. Friends, this IPO provides a unique opportunity for investors to participate in the growth of one of the fastest growing housing finance companies in South India. As you would probably know, the IPO is opening on Tuesday, 10th August, and closing on Thursday, 12th August, with an anchor scheduled for Monday, 9th August. The price band of the issue is 346 to 353 rupees per share, with an issue size of around 2,780 crores at the top end of the price band. The IPO consists of fresh issue of 500 crores and an offer for sale by selling shareholders amounting to 2,280 crores. I seek all your support to make this issue a grand success. With this request, I welcome you all once again and would like to invite Mr. Anandan to share his thoughts and take you through what has been a momentous journey for the company. Thank you.
Thank you, Mr. Jacob, for the introduction to Aptus Value Housing's initial public offering and the issue's key highlights. I would now request the company team to take us through the organization's journey, struggles, victories, subsequently take the attendees through the company's investor presentation to cover its business and financial details, as well as touch upon its key strategies going forward.
Thank you, Lalit and Debbie. Good afternoon to all of you, gentlemen, and thank you for taking time to attend this meet. I'm the founder and CMD of the company, I have a large experience. I've been present in the financial services, retail financial services for many years. My last stint was with Cholamandalam Finance Investment Company for a 20-year period between 1988 to 2008. And I formally retired in 2008. When I was wanting to do something at that point in time, mortgage finance came to my mind. We all know that mortgage finance is largely dominated by the big organizations, both the housing companies and the banks. And there was little opportunity, obviously, for the smaller players like us. But having said that, when we looked at the market a lot more closely through different filters, we found that there's a significant gap, underserved, unserved market, particularly for the last mile customer, self-employed, from lower and middle income group, largely coming from Tier 3, Tier 4 cities. By and large, this market at that point in time, maybe even to some extent, now seen as a high risk, high delinquency market. But having said that, but there are players like, for example, Greg Home Finance, who did this business extremely well, for many years. And some of these companies were really role model for us. And that is really what made me to think about getting into the affordable housing finance, and then the name Aptus is born. Aptus, in brief, is a Latin word, and the literal meaning of English is really apt, appropriate. Our objective is to provide appropriate and suitable home loan solutions to our chosen customer segment. And we have really started this company at the same time realizing the fact that this business needs a different business model, either in terms of the entire loan cycle, whether it is origination of the credit proposals, credit underwriting, legal and technical verification, and collection. The entire loan cycle needs a different business model than the what being followed by the formal large mortgage finance companies. So we had gone for that way, a totally distinctly different business model. So we'll go the details later in the presentation. Equally is that we always believed in the philosophy right from day one. This organization will be driven by credit and credit orientation, credit culture, rather than a sales oriented organization. And also some of these basic aspects have really ensured us a good growth, a reasonably good growth in the last 10 years or so, resulting in today the company is operating out of 4 states in South with about 190 branches, about 2,000 employees, and it has, as on March 21, as been mentioned, our AUM we finished with an AUM of 4,065 crores and in a top line income of about over 660 crores and PAT of 267 crores and a good financial metrics in every angle, be it our yield, be it our cost of operations. We are one of the very low cost operating company. Basically because our not only the OPEX, our credit culture has ensured a highest quality of portfolio, lowest quality of delinquency and write-up. We have been operating at the highest productivity field level, resulting in our OPEX is one of the lowest, and which resulted in our ROA and ROE, one of the best in the industry. With this brief remarks, I would request Mr. Balaji, our CFO, and G. Subramaniam, our Executive Director of Operations Risk, to go through a brief presentation, and we'll be happy to take the questions thereafter. Thank you.
Thank you, sir. Good afternoon, everybody. Apart from three of us who are there in the call, there are around 7 people who are forming part of the management committee team of Aptus, heading various verticals like business development, legal, technical, credit, HR, IT. All these persons who are forming part of the management committee are there in this company right from the inception. This is the snapshot of our performance for the year ended as on 31st March 2021. Our AUM was at 4,065 crores and our profit after tax was 267 crores. Our NPA was at 0.68% and ours is a 100% secured retail book, security being self-occupied residential house property. We have grown, our AUM has grown at a CAGR of 42% and PAT has grown at 59%. Our credit costs are very minimal and ROA is one of the highest in the industry at 7.4%. I'll come to the details of this ROA in the subsequent slides. This is the evolution of this company. This was commenced sometime in 2010 by Mr. Anandan, who was the earlier managing director of Cholamandalam Finance. And over the last 10 years, we have grown and we closed FY21 with an asset size of 4,065 crores and an NPA of 0.68% and a profit after tax of 267 crores. Over these 10 years, there have been 3 rounds of capital raise and in all 3 rounds, Westbridge had participated. In the last round, which happened in September 2019, apart from Westbridge, Sequoia, Stateview and Malabar also participated in the capital raise. What are the key strengths of Aptus? We are undisputed leader in the attractive South market. We operate out of 4 southern states of India. Our asset quality has been superior all through right from the inception. Our NPAs have never crossed 1% right from the inception. And we have an industry leading profitability as is reflected in the ROA of 7.3%. And we have presence in large underpenetrated market. And we have always been on the right side of law, setting highest standards of corporate governance.
We are present in 4 states of South India, that is Tamil Nadu, Andhra, Telangana and Karnataka. These are the states where per capita income is high and also the GDP growth is high. And as you see the slides, the delinquent levels are very less as compared to other parts of India.
This is a slide which explains the products offered by Aptus to its customers. The first one is the home loans. This constitutes 52% of our total AUM. These are loans given to the customers for either construction or purchase of property. Then comes the non-housing loans, which gets booked under our housing finance company. There are basically 3 categories of loan which gets booked under this category. The first one is the insurance loan. This constitutes 3% of our total AUM. Comes the top-up loan, which constitutes 5% of our total AUM. These are basically loans which are given for either extension or renovation of houses. Though this can be classified as housing loan as per the NHB norm, due to the practical difficulty involved in getting the local authority approvals, which is a prerequisite for getting it classified as a housing loan, this gets booked as non-housing loan. Then comes the quasi-home loans, which constitutes 13% of our total AUM. These are loans, we are in the business of financing self-employed customers who have their own businesses. These customers, when they are running the businesses, come across business surplus. So they use that surplus for completion of construction of their houses. After 3 to 6 months of completion of construction, they find themselves cash short for running the business. So they come to us for a loan. As this cannot be classified as a housing loan as per the NHB norm, we classify it as a non-home loan. Then comes the business loans. This constitutes 27% of our total AUM. These are the loans which gets booked under our NBFC, which is a 100% wholly owned subsidiary of our housing finance company. And these are loans which are given to the customers for enhancing their businesses. We don't give these loans for consumption purpose like marriage, education, etc. I was talking to you about this ROA of 7.4%, which is clearly 3 to 3.5% more than our peers. The major reason for this is the product mix, which I just explained, and also the yields which we generate on these products. We charge anywhere between 14 to 14.5% on the home loans, and on the non-home loans, we charge 17 to 17.5%, and for the business loans, we charge 21%. When the blended yield of all this comes to around 17 to 17.5%, which is clearly 3 to 3.5% more than our peers. This is greatly contributing to the ROA differential.
Talking about our niche segment of customers, our customers are low income, middle income customers, self-employed, rural and semi-urban, and 41% new to credit. 3 important factors. One is all our loans are secured loans. We don't do unsecured loans. All the security is against self-occupied residential property. We don't fund against commercial property and vacant land. And all the properties, it is registered with the government. So if you take the EC of the property, you can find the customer name and our name. Also, all these customers, this is their first house. They live in that house surrounded by the relatives and also community members. So they have a good amount of emotional value attached to the product. Rather than concentrating on the resale or purchase of customer buildings, we concentrate our self-construction model between 8 to 10 lakhs. The self-construction model works something like this. The land is owned by them, say value is 10 lakhs. Over and above that, they construct a 900 square feet for about 12 lakhs. So total value is 10 plus 12, 22 lakhs. We will be funding 9 lakhs. So 9 upon 12 on the total value and 9 upon 12, 9 upon 22 on the total value and 9 upon 12 on the construction cost. Also, we are very clear on the end use of the loan. We track them, and also stages of construction, we clear the amount disbursed to the customer. Also, we don't fund in interior villages, we don't fund in agri lands, and we don't fund isolated properties. I'll just take you through some photographs of some customers and the property what we have funded. Yeah, on the left hand side is the business and right hand side are independent houses. One is the vegetable trader. The next is provision shop. Here both house and the provision shop in the same place. This is a coconut wholesale dealer. This is a large business in south of India. This is a service center and this is the property. This is a person who does fishing in the ocean. The boat is owned by him and this is the property. This is a tailoring business normally done by ladies. This is a typical medical shop. This is a small eatery. Eatery seems to be small, but then the property is really good. So he seems to be making good amount of money from the eatery. This is a typical garment shop. This is a welding and fabrication. The customer also owns a car. This is a typical Hindu Purohit. This customer has never defaulted for us from the past. These are some of the profiles of us actually. Talking.
One second. Yeah.
This is the big differentiating between Aptus and the other financiers. We do everything in-house. We don't outsource any of the operations. For the sales, we do in-house. We don't employ DSAs. That is the reason we know the micro market and the customer profiles very well. The legal is done by qualified lawyers and technical by qualified valuers. We have got 300 strong collection team, and also we have got the credit, both branch credit and the HO credit. Here, one important point of differentiation is the decision to lend is taken at a HO level. It is not decentralized to the branches. The independence functions like legal, technical, and credit, their incentives are not linked to the volume of the business done at the branch. And also these functions, independent silos, they report to the head office. They don't report to the branch manager. Because of all this, we have not found any kind of collusion happening between people in the last 10 years. Since the entire thing is done by in-house staff, our knower employee is very important. We take stringent mechanism when we recruit the employee and induction and ongoing training. Because of all this, we are getting a pricing power, reducing turnaround time to the customer. Our takeover to other financier is very less. Since the DSS are not involved, they are the people who keep on churning the portfolio. Our takeover is very less. Basically, our closure itself is 6%. Out of that, 4% comes from customers' own source of funds, and 2% comes from takeover to other financiers. Our fraud loss in the last 10 years has been nil, and we are very transparent with the customer. All our communication with the customer is done in the regional language. So there is a trust established between the Aptus and the customer. We have got a good leverage of technology. We have a separate slide on that. On the referral mobile app, we have got a referral mobile app where people who sell cement, hardware, sanitary ware, when our self-construction customer goes there for buying this material, they will refer the customers. They are not financial intermediaries. We pay them a small referral commission. Through this method, we are able to get a good number of customers in the self-construction model. Our credit underwriting model is a proprietary model where we have got 60 to 70 standard profiles. We have developed it a long time back and evolved it according to the changes in the environment and also our portfolio behavior. Basically, we do a business verification in the place. We stay there for 2-3 hours, understand what kind of business, the profits, customer footfall, the stability of business, and also go to the residents to find out lifestyle, where schools children they are studying, what are the vehicles and other things. And then based on that, we put them, we arrive at a surrogate income. But this is not the end of it. We put them to a confirmatory test. The confirmatory test is that where what kind of savings he has done in the last 3 to 4 years. We believe that if the customer has an income, he should have savings. If the savings is there, tangible, normally these kind of people, they buy land, they construct the building, and they also, this part of South India, the chit funds are very high. They invest in chit funds. So if the savings are there, we clear the proposal. If the savings are not there, then it indicates a lot of things like the customer may not have the business does not belong to him, his savings is not there, he has got debt in the market, or he has got bad habits where he is spending his money. So we don't want to fund such customers. Also, post disbursement, after 3 months, we go and verify the customer business place and the residence property once again. This acts as the biggest deterrent for people acting in the stage one. We also follow the customer for 15 to 24 months to see what kind of early defaults, what kind of learnings, so that these kind of learnings can be incorporated in our future lending. Our customers, typically this segment of customers, there will be 20 to 25% bounce of the instrument, though we collect match from 100% of the customers. We need a very strong collection mechanism to collect this money from the field. Despite all these steps, some customers will go into NPA. We take legal action in SARFAESI and arbitration to settle the loan with the customer. All these parts of the business, we have got a dashboard on the daily MAS where it gives information on the daily basis so that we take remedial action immediately rather than wait for the period to get over.
Yeah. All these measures have resulted in the very good quality of book. Our NPAs have never crossed 1% right from the inception. In fact, up to FY19, it was in the range of 0.4 to 0.5%. Due to COVID-1, it inched up a bit to 0.7%. And for FY21, we closed with an NPA of 0.68%. Our credit costs have been very minimal right from the inception.
We have seen these kind of headwinds in the last 10 years, including demonetization, GST implementation, NBFC, and also COVID. We were able to maintain our AUM growth, yield, ROA, and also maintain our GNPA over this period. This gives us confidence that these kind of things we can handle in the future. More important, this gives us confidence that our customers are also able to withstand this kind of changes which happen in the environment and the economy.
Our ROA has been more than 7% both in FY20 and also in FY21. Our ROE is slightly less because of the capital raise that happened in September 2019. Our profit after tax has grown strongly, and we reported a profit of 267 crores for the year ended 31st March 2021.
This is a comparison of Aptus with the other financials. The one important point here on the return on assets, ours is 7% and others is 3%. Even the 3% is comprising of an element of assignment and upfront of profit. Aptus doesn't have any assignment. Aptus doesn't have any upfront of profits.
Our rating is A+, both from ICRA and CARE. This is one area where there is a scope for improvement. We have been approaching the rating agencies for an upgrade. If this happens, our cost of funds will reduce by at least 1 to 1.5%. Despite this, our incremental cost of borrowings in FY21 has reduced to 7.7%, and resulting in the overall cost of funds reducing from 10.2 to 9.1.
This is on the number of branches. 108 branches has got a AUM of 30 crores, 63 branches has got 12 crores, and 90 new branches has got 1.6. In the new branches, first we inculcate the credit culture in those branches, handhold them, train them, and ensure that they are on par with all other Aptus existing branches. Then we take them to the first level of 10 crores. On this 108 branches, there are even branches which has got 90 to 100 crores of AUM. So our aim is that it is not a saturation point. So we can take this 108 branches from 30 crores to the next level of 70 to 80 crores. And also the 63 branches from 12 crores to 30 crores and to the next level of 70 to 80 crores.
Yeah, I'll just skip this slide. This is the stable management team right from the inception. Apart from 4 of us, there are 6 people in the management committee team who are there in the company right from the inception. We have an experienced and well-diversified board. Our directors have got experience in running a bank, life insurance company, mutual fund operations, and also private equity operations.
We have got a very strong alignment of interest across all stakeholders. For employees, we have got ESOPs. As explained, the management committee is stable for last 10 years. We have got very stable area manager and branch manager, middle management. We have got some kind of attrition in the field scope, like sales and collection, but that is also comparable with the industry. We follow ethics, transparency throughout the 10 years. That is why we have got a high investor confidence. All the 3 rounds Westbridge has invested, and also in the latest round by Secure State Bio and Malabar. This is on the ESG focus. We talked about our customers. All our employees are locally talented people recruited. They know the area very well. That is why we are able to do good business and the collections. We have got a very strong corporate governance. All the 10 years nil related party transaction, and all the 10 years our statutory auditors has been Deloitte and Ernst & Young. Internal auditor has been RG Price and Company, and we have got a strong IT person, renowned person to do our IT and cyber security audit. Talking about our growth strategies, we will continue to be in the focus of the 3 products: home loan, quasi home loan, and business loan. We will not do any kind of diversification into any of secured or unsecured products. We will concentrate on the self-employed segment between 5 lakhs to 15 lakhs. New to credit retail segment, we will not do any wholesale or a builder segment funding. We will maintain and improve upon the customer profiles to increase the business and also manage risk. On the geography expansion, our first aim will be to take maximum productivity and business from the existing branches, as we saw in the previous slide. Then we will go deeper and deeper in the states where we operate: Tamil Nadu, Telangana, Andhra Pradesh, and Karnataka, so that we are number 1 in each of these states. Also, parallelly, we will do a contiguous market expansion in Maharashtra, Odisha, and Chhattisgarh. But there again, we will go where it fits our self-construction model. We will not go into Mumbai or Pune, which is a typically flat culture market. Our borrowing profiles are highly diversified, and as we continue to improve the rating, our cost tends to come down. This is on the IT map of the company. It is a key enabler of growth. The main thing is our lending software. Our lending software is end-to-end software connecting the credit, legal, technical, collections, loan origination, loan management, financial accounting, financial reporting. Its software is called UNO. It is an end-to-end software. You enter a data, you will get your P&L and balance sheet on a daily basis. This is the same. This is developed by Novak Technologies, and this is the same thing which is used by bigger companies like Sriram Transport, City Sriram. So it gives us confidence that as we increase our volume of business in the next 7 to 10 years, this software will help us grow in the particular business. Also, in addition to this main key lending software, we have got sales app, referral app, customer application app, geotagging app on onboarding the customer. This reduces the TAT to the customer and also has a lot of controls attached to that. As we told before, we have got about 20 to 25% bounce of the instrument. To maintain this, we have got a collection app, which also tells us about the productivity of visits made, customer made visits, and kilometers and things like that. We know this is a touch business. Our customer relationship is very important. Referral business are very high from this existing segment. Word of mouth is a very big business in this particular segment. So we have got a good customer relation app where customer knows which stage of disbursement he is, login, sanction, disbursement. He can give his query and complaints and also refer his friends and relatives to Aptus. To manage our 2,000 strong human resources, we have got this human resource management system. It starts from attendance, the payroll, the leave records, more important, the productivity on a daily basis, so that we can able to do more, produce more at a less cost. On the business intelligence and the dashboard, it tells us where we are doing really well so that we can maximize the opportunity and increase the business. Where we are not going well, to rectify those things, make it in the future lending norms so that we avoid the delinquency in future.
These are the numbers which are available in the DRHP or the RHP. We can take the questions on these in the question and answer session. I'll just explain about the ROA tree. As already told, our yields are at 17.6%. Our other income to the loan book is 0.5%. Total revenue to the loan book is 18.1. Finance cost to loan book is at 5.7. This is low because of the low leverage. The spread on the loan book is at 11.5%. OPEX to loan book, which is the lowest in the industry, is at 2.7%. Credit cost to loan book is at 0.16, resulting in a ROA of 7.4%. On the borrowing side, we have got support from 20 lenders, including NHB, IFC, mutual funds, private sector banks, and public sector banks. We understand that we are in the business of long-term lending, so we also borrow long. Our average tenor of borrowings from banks ranges from 5 to 7 years, and from NHB ranges from 10 to 15 years. Our overall tenor of our borrowings is at 83 months. Our NHB borrowings as a percentage of total borrowings is at 23% as on 31st March. Now, coming to the shareholding pattern, Mr. Anandan, who is the founder promoter, holds 25.2% in the company. Westbridge Crossover Fund, who has been identified as investor promoter for the purpose of IPO, is holding 35.7%. Their affiliates hold 12.8%. Relatives of Mr. Anandan holds 1.2%, more over and above this 25.2%. This is one company where the promoter holding is more than 25% at the time of going to the IPO. With this, we come to the end of the presentation. Thanks for the patient hearing. We'll get into the question and answer session now. Thank you.
Thank you for taking us through the presentation, sir. The Indian housing finance market clocked a healthy CAGR of approximately 12% over fiscal 2018 to 2021 on account of rise in disposable income, healthy demand emanating from smaller cities and markets, attractive interest rates, and the government's impetus on housing. We hope the attendees have captured enough and more understanding of Aptus Value Housing's business model, financials, and its execution capabilities. Before the floor is open for the participants to ask their questions, I would like to reiterate to type your name and organization details in the Q&A chat box for the moderator to take note and address your query. Note, in the interest of time, we will be restricting to 10 to 15 questions only, and repetitive questions will be skipped. So there's a question which is asked that, you were showing a good growth, so far, and you have a very low NPA. Is it still possible, when you grow with more than 180 branches to maintain this?
Yes, very firm affirmative answer, yes. Our growth strategy really revolves around 2-3 key points. One is that we are highly focused in what we want to do. And the focus of the company is really providing the retail home loans to the last mile customer coming from lower and middle income category, coming from largely in tier 3, tier 4 cities. And this is really the product, and this is really the customer. And we shall not have any diversification into unrelated products, areas, corporate, builder, etc. Second key component of the star growth is really in terms of our philosophy and geography. We don't believe in wanting to be an all India company from day one. In the sense that we believe in a deeper and intense presence with an aim to become a leader in that area. And that's why, being headquartered in Chennai, Tamil Nadu, we started Tamil Nadu and diversified into 4 southern states. And the medium to long term will also diversify into other states, namely on a contiguous basis, namely Maharashtra, Orissa, and Chhattisgarh. So in other words, this is where our geographical strategy in terms of 190 branches today, we have about 78 branches or so in Tamil Nadu, about 66 branches in Andhra, and about 23 branches in Karnataka, and about 22 branches in Telangana. And our strategy of growth is really one component of the business growth, geographical growth, is that get more business, through the talent management, through the management of business processes, get more loan book, increase the loan book in each and every area for our branch. For example, this 108 branches which is 3-year-old, having a loan book of 30 crores on an average. But there are branches with a loan book of 75 crores, 100 crores over here. For example, there's a place called, Nagarkoil and Marthandam, where our loan book is closer to about 85 to 100 crores. So in other words, our first objective is really grow the loan book in the existing branches, meaning, the 108 branches where the average will move up more than 30. And the other set of branches, 68 branches, which are really 1 year to 3 year, where the average loan book is only about 12 crores or so, and it will move up first level 30 crores and thereafter higher. And we have about 19 branches, as you must have noticed, with a less than 1 year, where the loan book is only about 1.2, 1.3 crores. Now, this is where we really move into the next level. So, in other words, the growth per branch is will be the first objective. Second objective is really add more branches in the existing 4 states itself. As I mentioned, while we have 78 branches in Tamil Nadu, we only have 21 branches in Telangana, or 65 branches in Andhra. So we'll add more branches in the 4 states, existing 4 states. Then we will add, 3 adjacent states on a contiguous basis, states like Maharashtra, Orissa, and Chhattisgarh. So that is really, and fundamentally, the other aspect is that while the overall market, the mortgage finance is growing at around 12 to 13%, but the affordable housing per se, affordable housing finance companies, which is now being segregated even by some of the even credit bureaus and other data, you will find that the growth rate is much higher. It's almost about 18%, 19%. The objective of the company is really to grow 1.5x of the industry growth, affordable finance, housing finance industry growth. That's where we are really aiming, budgeting for a growth rate of almost 30% CAGR in the next, minimum 5 years. Because basically the home loan, the need of home loans, the need for credit for the home loan are much more only in the lower and middle income population, and largely self-employed, largely from tier 3, tier 4 cities. And that's where our focus. So there is a market, large market, underserved, unserved. Of course, there are challenges in doing this business. But then having said that, but there is the market provides right opportunity for substantial growth going forward, and we're confident of pursuing this growth without really compromising our quality of assets or our financial metrics.
Okay, thank you, sir. A question coming in: how many disbursed loans are based on variable interest rates, sir?
Currently, actually, our variable rates are only around 21%, and fixed interest rates are 79%, which will appear to be somewhat at odd at the normal practice prevalent in most of the housing loan companies. Because the moment when we say housing loan companies, we are, one is used to the philosophy of variable rates. But having said that, this market, this category of customers are different. The average size we give a home loan between 5 lakhs to 20 lakhs, 45 lakhs, and our average size of the loan is about 8-9 lakhs. And our average EMI is 12,500 rupees per month per house they live in. Now, if an interest rate goes up by 0.5%, let's say our EMI could go from 12,500 to 12,550. Or if 0.5% comes down from 12,500 comes down to 12,450. And these typical last mile customer, who are self-employed, again, given their profile, they don't want to get in this matrix of, they don't understand the interest rate volatility. They don't understand the interest rate behavior globally, nationally, and otherwise. As a company, we have provided both the options to the customers. We have given the option to the customer. They can choose fixed rate. They can choose the variable rate. But most of our customers, because of the small size of the loan, because of the small size of the EMI, and because where they come from, and they said this interest rate volatility is something the company can manage. And for that, if the company wants to charge, because fixed rate loans, 0.5% more, they're willing to pay. So in other words, this class of customers, we find that, it is, they prefer, a sort of fixed interest rates more than the variable interest rate.
Okay, sir. Moving ahead with the next question is, could you reiterate on your cost of funds over the last three fiscals and what is your lending rate?
Balaji?
Yes, sir. Our lending rates have been consistent, as I told earlier. For the home loans, we have been charging interest rates between 14 to 14.5%, and the non-home loans at 17 to 17.5%, and business loans at 21%. The yields have been consistent at 17.1 to 17.6%. As regards the cost of borrowings, our FY19 cost of borrowings was at around 10.5%, and FY20 became 10.1, and FY21 it became 9.1, and this is what is on the cost of funds trajectory. But the thing is, like, once we go for a rating upgrade, we are likely to get an reduction in the cost of funds by at least 1 to 1.5%, and the effective cost of funds as of now is 9.1. It is likely to settle around 8%.
Thank you, sir. The next question is on collection efficiency, which states that why is the collection efficiency at 94% in July as against 98% for the two listed peers, which is Aavas and Hopus?
I know where you got this in the month of July. If you're talking
No,
about
no, sir. I think, sir, once again, I think it is the combined collection efficiency for all the 3 months.
Yeah,
that
all
they are
the
talking.
yeah. You see, what the data given is an average of April, May and June and this thing. Okay, I just to reiterate once again, our April we had a 95% collection, May we had 88% collection, our June 98%, and in July we have touched 99% collection.
Okay, sir. Moving with the next question, the home loan yield is quite high in comparison to peers, despite operating in southern India. Relatively better banking penetration. Could you throw some light on that, please?
Basically, we are charging, as has been mentioned, 14 to 14.5%. Even there are peers who are really competitors who are really in this segment, they charge anything between 12.5 to 13%. Now, we find that, at this rate, we also consider the fact that, so a significant part of the loans are fixed interest rate loans. And the fact that in fact, we are operating in these rates in the last almost 10 years. And in the past, we did reduce a bit. And going forward also, we may look at minor reduction in these as our funding cost comes down, without really compromising much on our ROA, NIM, ROA, ROE. We will have the flexibility to look at it. But as of now, we don't really lose any business because of these rates, because the competitive pressures and the competitive landscape in South versus West or North are different. In South, these rates are okay for us.
Okay, so moving to the next question, being you have no exposure to builder finance. Will you look into it? What's your NPAs in business loans? Are microfinance institutions a competition there? Also, an add-on question to that, are the people who you give business loans to unique or existing customers?
Okay, I'll take that question.
Yes, go ahead.
I'll take the last one first and move on to the other questions. All the customers are unique loans. There is no different. We don't fund more than one property to one customer, except for the 4% top-up which we have seen on the side. So each of the customer is a self-occupied property, individual, and one customer, only one loan. Our customers don't have more than one loan. The second question you are asking about the competition from the microfinance, we have not seen any kind of competition happening because microfinance operates in a self-help group in a different segment itself. We have not seen that because when we take the high mark report, when we fund the customer, we have not seen our customer taking loans in the microfinance market. Third, you have asked about the builder finance. In the future also, we will concentrate in our own self-construction model of business, our home loan, Kasi home loan and business loan. We will never enter this segment of business loans or corporate funding and a wholesale funding and things like that. What was the first question? I just forgot that.
One was on builder finance, sir, and
Builder.
and
Yeah.
the next one was what is your NPA in business loans?
Yeah, normally this profile of customers are same. The self-employed customers for business loans and also in the home loans. But having said that, our overall NPA is 0.7. Business loans will be about 0.2 more than that, about 0.9, 0.92 will be our NPA on that.
No, we will never do the builder loan because we don't fund apartments at all. And builder will, that's strictly no.
Okay, sir. And moving to the next question, what is the current housing shortage in rural markets in India? Do you see mortgage penetration in India improving anytime soon? What are the factors affecting it?
See, actually, one is that as a general economy in the 4 states where we operate, it is a stable economy, politically very stable. GDP and other things are going well. So we foresee a big quantum jump in the movement in the housing loan demand in this market. Second thing, we also see 2 things: people moving from hitherto putting their own money and constructing the house. Now they are going and taking loans and constructing the house. Third, also we see that people moving from unorganized sector, hitherto they were borrowing from local financiers. Because of the availability of funds in the organized financiers, they are moving to organized financiers much better because they know the customer service is very good. And our intention is to lend and take our money, not like private financiers who sometimes they wanted to take back the property from the customers. So they are very clear, they want to move from unorganized players to the organized players.
Thank you, sir. Moving to the next question, what is your average turnaround time to sanction loans?
Yeah, normal average turnaround from customer meeting to getting the disbursement is about 14 days. But 4 to 5 days, we will be able to give a sanction letter to the customer. The remaining 9 days normally happen because the customer has to produce legal records. It has to satisfy our internal lawyers, policies, and other things. Basically, there is a government agency involved. He has to go to the SRO to take all the government records. So it takes that kind of time. 5 days for sanction and overall from meeting to disbursement 14 days.
Thank you, sir. We have moving to the next question. We have an increasing cash collection trend. What are your targets to have 100% non-cash based collections? Do you think it's possible?
Yeah, we have taken NACH mandate from all the customers. Every customer of ours does have a bank statement. 75% pass through the normal NACH mandate, but we get about 25% bounces. Normally 20%, now it is 25%. We have all the methods like Google Pay, Paytm, and all those methods given to the customer to pay through that method. But given the nature of the business of these customers who does mostly in the service sector, cash and carry business, most of the people prefer to have cash and repay through the cash method. We try to educate the customer to pass through the bank's method, but I think it will take some more time for us to completely satisfy. To answer your question, to move to 100%, it may take a longer period actually.
Thank you, sir. Could you give an indication on who your top 10 investors are in the company and how much stake are they diluting in this IPO process?
Balaji?
Okay, sir. The top investor is Westbridge, who is holding around 45 to 46% in the company. Their affiliates is offloading around 10%. So after the IPO, they'll be holding 36%. Then Mr. Anandan holds 26.2%, and Malabar, which is a private equity fund, is holding around 8.1%, and Sequoia, State View each hold around 3.3 to 3.4%, and Granite Hill Capital Partners they are holding around 2.1%, and they are also selling it in the OFS. These are the major investors in the company.
Thank you, sir. Our cost to income ratio is one of the lowest in the industry. Are we looking at measures to bring it down further?
No, actually, we've been progressively bringing down our cost to income ratio, and it is one of the lowest in the industry. We currently stand at about 2.7, coming down from as high as over 4. And there is little scope for further reduction in our cost of operations. But we are quite comfortable with that. in the sense that, we will bring in the efficiency. The only area where there is a scope for reduction is our funding cost, as explained by Mr. Balaji. Barring that, our operating cost per se, there is not much scope for further reduction.
Thank you. So the next question being, how high can our operating leverage go? What is our comfort level?
Currently our leverage is low, and on a steady state basis, we would be looking to operate between 4 to 5 times of the leverage, being a standalone company. And that's something which we will be looking at.
Thank you, sir. What is our net interest margin in FY21?
It is actually 10.5%. Actually, 17.5% is our blended yield of the portfolio, and our cost of funds are about 8 or so. So, it's really 9.5, 10 in that range.
Thank you, sir. Have we ever faced any issues since our inception in servicing our debt obligation?
No.
Nothing. Nil.
Thank you, sir. And with respect to the COVID impact that has taken into a lot of companies, how have we circumvented this issue?
Actually, we also been impacted like others, but we've came across very high level of resilience in our customers, because most of our customers they are in the service businesses. They are not agriculture, they are not in manufacturing, they are not in a contract kind of businesses where the monthly cash flow won't be there. And these are small businesses, though they've been impacted by the COVID, they're able to come back fairly very quickly, because if it is a provision store, even if it is closed for a month, within 3-4 days, they are able to come back and do their business. Also, given the small size of the loan and small size of the EMI, because their average EMI is 12,500, is what they pay for the house they live in. And to that extent, they're able to service it well, even in a most difficult times. As evidenced by the fact, in April, our collection was 95. In May, one of the worst months in COVID too, collection was 88. And then June, it came back. Even as of June, it came back to 98. And July, little over 99%.
Okay, sir. Moving to the next question. How many branches have been shut in the past? How many branches are generally added annually on a historical basis? If you could recognize that.
Yeah, normally we don't shut branches. Okay, some of the branches who are nearby branches, 1 or 2 branches where it was not operating to the efficiency, we have merged those 2 branches. Some 1 or 2 branches in Chennai and things like that. So we have not shut any branches as such. Generally, we open about 20 branches in any financial year. In the COVID year, we are only about 10 to 12 branches. But in general years, normally we open about 20 branches.
Okay, sir. Could you throw some light on your capital adequacy ratio of 73%, sir?
Balaji.
Yeah, due to the low leverage, the capital adequacy is currently at 73%. As Mr. Anandan told, over the years, they will not come to the capital market for additional equity raise. So once the leverage improves, the capital adequacy levels will come down, and it will be at the optimal levels.
Thank you, sir. Moving to the next question. What are the risks associated in case a default is in place, and what is the process to recover it?
Yeah, normally when the case goes for a default, first is that we have to see whether it is a fraud loss. Normally, we have not seen any kind of fraud loss in the last 10 years. It could be the 3-4 aspects. One is the health issue which the customer may overcome after some time. Second, the death of the customer is one particular issue, but we have covered the customer through our term insurance loan. Third thing, there could be a capacity issue or there could be intention issue from the customer. Unfortunately, if these things happen, we take recourse to our legal means through SARFAESI, arbitration, and also 138. Here in this part of the country, this SARFAESI is very fast. We are able to get orders from the court. And once we get take symbolic question and all those go through methods through Sarfasi, customer normally approaches for settlement because he is living in that property. It is surrounded by his relatives and community members, so he doesn't want his just to be sacrificed. Third particular point, very important, even at a funding stage, the LTV is 40%. So if we repossess and sell it, there will be a big loss. The equity of the customer is big in the property. So normally he will come to our settlement and we will get our money back. So this is the whole process.
Thank you, sir. Moving to the next question, how does centralized credit process help in ensuring a lower NPA level? Why not decentralized to get a better granular understanding?
So two aspects in this particular centralized versus decentralized model. Each has got its own merits and demerits, but we have chosen to follow the centralized model. First is we have got about 25 to 27 people in the centralized credit who specializes in some of the products, some of the regions. Say, for example, some deal with Telangana, some deal with Andhra Pradesh, some deal with home loans, some deal with business loans. So that specialization happens. Second thing, we are able to keep continuous training on these 25 people, 27 people more easily rather than training our 200 people staff right across the branches. Third one, important factor in the financial service is that the independence of the person who signs the proposal is very, very critical to maintain the delinquency levels. The person at branches, after some time, the independence may get lost. And that is we have found in a lot of financiers, this was the biggest difference for the delinquents.
Thank you, sir. How many of your customers were new to credit in FY20 and FY21? Also in such remote markets, how do you operate in areas where infrastructure is limited?
No, we don't operate in a very remote places. South India itself is totally different. It is highly connected, highly developed market. We operate only in district and taluk headquarters. We don't go into a deeper villages, and also we don't fund, like what I said, agri properties, isolated properties, and things like that. New to credit, there are 40% customers who have got hit in the credit report. But that is also because of two-wheelers, used vehicle finance, and gold loans. And also some 15%, 20% customers has got borrowings and chit funds where we are able to get computerized statement, but that is not reflected in the credit bureau report. Chit fund is very, very famous in south part of India. Some of the names I could give you is Margadasi, Sriram chit funds, Gokulam chit funds, Kabil chit funds. There are very large corporate chit funds operating in south of India.
Thank you, sir. Moving to the next question. How many of your customers fall under the PMAY scheme?
About 3 to 4% customers fall into PMAY scheme. When the customer satisfied all the rules of the PMAY, we take the money from the government and give it to the customer. But we don't use it as like other financiers advertising it and using as a biggest selling point. We don't do that.
Thank you, sir. Moving to the next question. Will the high capital adequacy affect your returns in the future?
Not really. It will have some impact in the first year of capital raise. For example, we did raise the capital in September 2019, and we did raise something around 800 crores at that point in time. But despite that, our ROE FY21 was 13.4%, and if I recall, that is the highest of the comparable 4 competitors, including Avas, Comfast, and other.
Thank you, sir. Just to understand more on the adoption of technology from the risk management, collection, and underwriting process, could you throw some more light there, please?
Yeah, sure. I took you through that particular slide where I told you about our lending software. Talking about the risk management, we have got a very good software, the hardware part of it, the network security, the cyber security, business continuity planning, disaster recovery. We have got we have NetMagic, who is one of the leading vendor in the particular sphere, and our database. We have got one backup here in Chennai, one backup in Hyderabad, which is also in a different CMIC zone actually. Also very important, we talked about the business process like sales app, credit app, technical app, collection app, which helps us to improve the process, reduce the turnaround time, reduce the risk, and also increase the productivity and the profitability in each of the transactions.
Thank you, sir. What percentage of our loans are coming from the digital channel?
Digital channel, we have introduced this Echo Partner digital channel about 8 to 9 months. We have close to about 10% coming from this particular nature of business. But this will improve in future as it picks up.
Thank you, sir. Moving to your next question, which asks that did any of your customers avail for a moratorium?
Yeah, we have got we have not done any restructuring of loans. We have got moratorium in the first COVID. About out of our 4,065 AUM, we have got about 45 crores of EMI done moratorium. Generally, it is only about 2 to 2.5 months of this thing. We have not given any customers 6 months moratorium as done by most of the other financiers.
Thank you, sir. The next question asks at what rate do you borrow from NHB?
It is around 5.5%, and it's a fixed rate of loan. It's a long tenor funding we get for 10 to 15 years, and it is at fixed rate of interest. It is at 5.5%.
Yeah, just to add, NHB has got different lines of credit, including certain lines where the spread is determined by the NHB. Those loans are available even at a rate of about 4.5%. But then your lending rate is sort of in a way decided by NHB fixed spread. We don't go for that such type of loans at all. So we take loans where we are at liberty to charge the interest as we think is appropriate.
Thank you, sir. Moving to the next question, could you throw some light on the provisions that you provided?
Yes, sir. Yeah. We have been following this expected credit loss model under the Ind AS for the purpose of provisioning. And considering the business model and as certified by the ENY and also our internal auditors, we have followed this model and also considered the value of assets that has got funded, and considering the last 10 years behavior of our customers where there have been nil fraud losses and also no write-offs, and the probability of default is low for the kind of customers whom we fund, considering the business model. Based on that, the provisioning has been made. And over and above that, in FY20, we have made additional provision of 1.5% for the purpose of 1.5 crores for the purpose of COVID. And in FY21, we have provided additionally 2.5 crores. And this has been audited and accepted to by both internal auditors and the statutory auditors.
One point here I would like to stress on the provision is that other than like vehicles, ours is appreciating assets, because land value is the biggest component in the self-construction loans, and we have only 40% LTV in these loans.
Actually, we carry as at March, just to add, 5.3%, 0.53% as the total provision of the book of the 4,065 crores. We carry a provision of about 5.53%, which we find is very good enough for the reasons explained by Balaji. Some of our competitors, they do carry a provision of, I just checked few of the competitors, they do carry a provision of 0.8, 0.82, 0.83 and all. But there the NPA is slightly higher, and then the moratorium given is higher, restructuring given also is there.
Thank you, sir. Considering that we've answered most of the questions, and if there are some unanswered questions, definitely we'll reach out to the attendees. Thank you, everyone, for showing interest in knowing more about the company, its leadership and future potential. I would now like to call upon Mr. Mulya Goel from Citigroup Global Markets to make the closing speech before we end today's webinar.
Thank you, Lalit. Ladies and gentlemen, on behalf of the senior management of Aptus Housing Finance and the book runners, I thank you very much for taking out the time to attend this broker and analyst meet. It's indeed a very proud moment for Aptus Housing Finance and its founder, Mr. Anandan, and all its employees, and we would like to congratulate them on reaching this very important milestone. As you've heard, Mr. Anandan and his team, Aptus is a clear leader in the attractive South Indian housing finance market. It has a track record of superior asset quality as also financial performance and
sorry for the technicalities. It seems that Arvind has just dropped off.
Except in
can-
a battery issue.
Yes,
Yeah.
yes,
Yeah, you
absolutely.
should be joining.
So
yeah.
we can end the meet, esteemed audience. We have now come to the end of the webinar. We look forward to your participation and support in making this initial public offering a great success. Wishing you all a great day and keep safe.
Thank you. Thanks everybody.
Thank you, everyone.
Thank you all.
Yeah.